Okay, so we are broadcasting live once again. Patrick Whaley here, your friend in the mortgage business, joined by Declan O'Toole from Select Real Estate, host and co-host here of the Wicked Awesome Report, broadcasting every Tuesday and Thursday at 10 a.m. or 10-ish, depending on our technical difficulties getting going. So head over to the Facebook page for Wicked Awesome Report. Give us a like, a thumbs up. You'll be notified next time we are broadcasting live. Drop us a comment. Let us know if you want to be a guest and join us. Certainly looking for guests that have an interesting story to tell. Doesn't have to be real estate related, but since that's the business that Declan and I are in, that seems to be sort of the general theme. So again, another broadcast here of the Wicked Awesome Report. Thanks for joining us, Declan.
Thanks for having me, Patrick.
So today we're going to cover maybe a fun topic if you're not directly involved in it. Some of the disaster stories, the do's and don'ts when you're financing real estate and how things can go wrong and things can go sideways. And I actually have a list that I send out to clients, the things to do and things not to do when you're involved in a transaction. And I think what we might do, Declan, is just sort of run through, not necessarily a bullet point, but run through some of these things and have a little discussion about each of them, just to make sure that we try and help the audience here, prevent them from walking into a disaster as they're trying to finance a home.
Not a bad idea. I'm just looking at your list here, Patrick. You've got 7 do's, I believe, and about 15 don'ts. So I think we should certainly spend more time on the don'ts.
Yeah, I think the don'ts are, I think, can definitely be more important. So, the list here is not in any particular order per se, but let's start making a run through them, and with each item, maybe I'll give a little description as to why that item is important. So, first one here is, do continue to make your rent and mortgage payments. So I've been involved in transactions with clients, helping them with a refinance, and for whatever reason, they thought that because they're in the middle of a refinance, they don't have to make the payment on the mortgage that's being paid off. And that's not true. Okay. So continue to make your payments on all of your obligations until you're at the closing table and you're signing documents or you're getting those new keys in your hand. So if you're selling a house, it also applies. Don't stop making payments on the home you're selling simply because you're selling it and buying a new home. You still have the obligation to make those required payments every single month.
So Patrick, that screws you up if you're buying a new home, right? So I suppose just to clarify it, right? So you're paying off this other loan, it will show up on your credit as not having made those payments. I assume that's why you're getting at that.
Exactly. So what some consumers don't realize is just before you get to the closing table, so your transaction can be approved. You've got that closing date a couple of days, maybe a week away. You think everything's great, but prior to closing, a lender is always going to take another look at your credit report just to make sure that there hasn't been any significant changes, that you haven't opened any new loans or lines of credit, that you haven't skipped any payments and forgotten to make a mortgage payment. And if in fact that's the case, it shows up that, well, you didn't make that mortgage payment, well, that's going to be a problem. And chances are you may not actually get to the closing table. And really where that comes up is if a closing is delayed. So we're in the month of August right now. So let's say you're selling a house and you're buying a new house and the transactions are scheduled to take place on August 31st. That's what the proposed closing date is. Okay. So you as a consumer think, okay, well, hey, guess what? I'm closing here at the end of August. I have a mortgage payment that's due in August 1, but I'm closing in August. I'm just going to hold on to the money. I'm not going to make that mortgage payment.
It's not going to go 30 days past, right?
Well, yeah. So that's what their intention is. That's what their thinking is. But in the real world, we all know what happens. Delays can occur. And if you don't actually hit that closing table by the 31st and the payoff isn't sent to that existing lender, Well, lo and behold, now you're beyond 30 days late. And that may actually screw up in the very last, days being able to close on that home. And literally in the 11th hour and 59 minutes, that closing could be stopped because you didn't make that August 1st payment in that example. So, not to belabor the point too much, but you absolutely need to continue to make your payments on every single obligation until you hit the closing table. Don't skip a payment, even if you think that account is being paid off. You still have the obligation to pay it. If you do skip it, well, it could show up on that final review of your credit report just before closing, and actually prevent you from, consummating that transaction and getting through the closing.
That probably takes us to the second one there, Patrick. So you should also stay current in all your existing accounts.
Exactly.
Right?
So those two are kind of tied together. Yeah. So, it's really, any of those payments that are due, even if you're consolidating debt. So let's say you're refinancing and you're taking money out to pay off, an equity line or credit cards, auto loans, any other debt that you have. Well, if there's a payment that's due before you get to the closing table, make that payment. Continue to make payments, even if it's your intention to pay the account off in full once you hit that closing table. Because again, a missed payment could impact your approval and could actually reverse that decision, if you're not keeping current with all of your obligations. So just make sure you make the payment that's due as scheduled.
And then I suppose go ahead. You're talking about the other thing is the next one on the list is keep your job.
Yeah. So kind of surprising how often this shows up. And I talk to a lot of my colleagues in the mortgage industry all across the country, and you'd be surprised how often this happens, where just before closing, the home buyer changes jobs. They quit their job or they move from one industry to another. Believe it or not, it's really, really difficult to close on mortgage financing if you don't have a job. Okay. And it's also difficult if you've changed jobs during the process, because as part of the underwriting process, the lender needs to verify where you are employed, how long you've been employed there, what your income looks like. And if you're changing jobs midstream, well, it's tough to gather all the right pieces of information to fully verify what the job position is and what the income is. So changing jobs last minute just before you get to the closing table is never a good idea. And even if you're staying within the same company and you're changing your type of compensation. So let's say you're a salaried employee and you're offered a new position, which looks like it could be more income. Most people will think, well, hey, that's great. But the type of income is no longer a salary, it's a commission. That's going to be a problem, because commission income is a variable type of income. It's not a guaranteed or a set hourly rate or an annual salary. That commission is variable. It could be different from week to week or month to month. And if you don't have a history of earning that type of income, it's not going to be viewed as being stable, reliable, or consistent. Underwriting is going to have a problem with that, and most likely is going to decline the loan file. So you could end up in a position where, because you have the opportunity to earn more money, you don't have a history of doing that, the loan file could actually be turned down, and you could end up very close to the closing table, but no closing can actually take place.
The key there is if you're offered that position, you don't have to necessarily turn it down, but just be aware of your dates and make sure and give a little bit of room too, because these closings can get extended. Exactly. If you want to make a change, do it after you've taken care of that closing.
Exactly. So it sort of remains status quo. Don't make any changes to your financial condition until after you have the keys in your hand.
Got it.
Another one that's here is keep your same insurance company. So if you are refinancing a home, we need a mortgage lender needs to have information on who your insurance company is, because the mortgage lender is taking so that home is the collateral for the loan that's being issued. Okay, so the mortgage lender is named as an additional insured on that insurance policy. Because God forbid there's an accident or there's a fire, the home burns down to the ground. Well, you as the homeowner don't just get a check for the replacement cost. The mortgage lender is part of that process as well, because that's the collateral for the dollar amount that has been borrowed. So I'm not saying that you can't change insurance companies midway through the process, but you need to let your mortgage lender know if you're doing that, just to prevent any last minute glitches when you're trying to get to the closing table. And again, these are all sort of proactive items to give you advice. Unfortunately, with any of these, things don't really go wrong until the 11th hour. And we're just about at the closing table. And that's really the worst time that it can take place, because there's little to no time to fix or resolve the issues. So it's, what's that saying? An ounce of prevention is worth a pound of cure. So we're trying to give you some preventative medicine here. Continue using your credit as normal. So again, coming back to the credit, if you're using your accounts to buy gas or groceries or things like that, perfectly fine to continue to do that. You don't have to change all of your spending habits simply because you're going through the mortgage financing process. But what you should be aware of, you want to avoid any large purchases. Okay, and that's a little bit further down the list. So let's jump to that. Don't make any large purchases. So quite often it happens where, Declan, you've got someone who is working with you to purchase a new home. They're moving out from their first apartment or their studio or out of mom and dad's place, and they're buying their first place. And of course, they're going to need somewhere to sit. They need a couch. They need someplace to sleep. They need a bed. They need a kitchen table. They have to furnish the entire house. Okay. Well, that could be an issue when it comes to mortgage financing.
So if you go credit card, right?
Well, exactly. So if you go to a furniture store, and believe me, they've got all the great sales and the great promotions, and open a card and 0% interest. And as a consumer, you may think, well, hey, that's a great idea. It's 0% interest, so that's not going to impact anything. So I'm going to get that line of credit for $10,000, and I'm going to furnish the entire house and have all the furniture ready and delivered the day after I close on the home. Well, the problem is that does impact your credit. So number one, that's going to be a new account. Number two, even though it's 0% interest, for the first 6 months or 12 months, eventually there is interest that's charged. And even while it's a 0% interest, there's still a minimum payment that's going to be due. So the mortgage lender needs to take into account the cost of that minimum monthly payment for all that furniture you bought. And of course, this comes up to the people that typically can afford it the least. They don't have much room in their debt to income ratios. They're already maxed out in terms of what their income is and what their liabilities are.
Why they're using the credit.
Exactly. Yeah. So although you may be tempted to buy that new living room set, that new bedroom set, don't do it. Wait until you have the keys in your hand. And then if you want to go and buy that, that's fine. Listen, sleep on a mattress on a floor for a couple of days. Buy a blow-up mattress. That's fine. Okay. But don't go out and buy that huge furniture set and have new accounts where, you could be hundreds or in some cases even thousands of dollars a month for that furniture. Very well could knock you out of the box from being, approved for the financing. And again, usually doesn't show up until the last minute when it's sort of too late.
Patrick, have you had that happen? Have you had deals go where they bought the furniture? Or
yeah.
I know I've seen it myself where a boat was bought because they had, room for a boat beside the house. But
yeah. And it's kind of funny. People, buy a new home and it's sort of keeping up with the Joneses. Well, because this is a new home in a beautiful neighborhood, they need to upgrade their car to go with it. They want to have that new furniture set. They need to buy a motorcycle. So I guess a funny but maybe not so funny story from the consumer's perspective. So one of the tales of woe that I put out there for clients, the cautionary tale. So I had a client once who was just barely approved. So income was a little bit shaky, barely enough funds to put the transaction together, debt to income ratios, so pretty much maxed out in terms of what he could afford. But we got the deal approved and everybody was happy. Closing date is in sight. Couple of days before.
Talk about me, Patrick.
No, definitely not you. Definitely not you. You're smarter than this, Declan. So closing dates in sight. We do that review of the credit report, checking for new accounts, as we talked about earlier. And lo and behold, this individual bought a motorcycle, okay, which may be a great idea, in the summertime, but not a great idea if you're in the middle of buying a home. So, and I won't mention any names to protect the not so innocent, but this individual not only blew up his debt to income ratio, so now with the expense for that motorcycle, he didn't make enough income to qualify for the new home, all the other obligations he already had, plus the payment for the motorcycle. Over and above that, he spent the money that he had set aside to cover the rest of his closing costs and down payment. To this day, it still baffles me. I just don't understand how he thought that was going to be okay, where he spent the money he needed to complete the transaction and took on a new obligation. So the joke I use is, I'll ask clients, did you know that a motorcycle depreciates just as much, if not more, than a car as soon as you drive it off the lot? So for this young man, the only solution to the transaction was he had to unwind that whole motorcycle purchase, had to go back to the dealership, return the bike, got less than what he paid for the bike back, and close out the loan used to purchase that. So at the end of the day, he ended up with less money in his pocket, no motorcycle, and we had to extend out the closing date for about a week so that he could, undo that whole financial transaction. We were able to close on it, but it's just one of those situations where really nobody was all that happy when we actually reached the closing table. The sellers weren't happy because they had another transaction they were working on that got delayed. The buyer wasn't happy because he had to give back the bike he just bought, which he thought was going to look great in his new driveway. But the only other option he had was to sleep on the bike because he wasn't going to have the home and the bike.
Should have bought a car.
Weren't there. So so I had the unfortunate position of telling him that he had to choose between the house or the bike. So I think, maybe he came to his senses finally and he chose the house.
So what if he just applied for new credit and, got an extended credit line and bought the bike that way so he'd still have his cash?
Well, if he had done that prior to closing, it still would be an issue because it would show up on the credit report as a new account that we'd need to take into account when we're calculating the debt to income ratios. So really the advice is don't make any changes to your financial condition. Don't open any new loans or lines of credit. Don't close any loans or lines of credit. Just remain status quo until you've got the keys in your hand. Once the keys are in your hand, the house is yours. Apply for a whole fleet of motorcycles if you want to at that point.
So no big purchases. Make the payments as you always pay them. Yeah. Don't even pay down cards. So don't think that that's going to help either. So essentially, as you said.
Yeah. So that's a good item, and that's really transaction specific. So in some cases, you need to pay down cards in order to qualify for the financing. Okay, that does happen. But in other cases, the payments on those cards are okay. You can qualify. You need the cash to be able to complete the transaction for the rest of the down payment and the closing costs. So that's an item that's really transaction specific. The best advice I can give anybody is talk to your loan officer about it before you make those financial changes, because again, it's a little bit counterintuitive. You may think that, okay, I'm going to pay down this, $5,000 credit card. That's going to make me look stronger financially. Okay, that may be true, but if you need that $5,000 to cover your closing costs, that's not good.
Reserves.
You need that cash to be able to complete the transaction. So it becomes really more transaction specific in terms of paying down or paying off other obligations. But one thing that I mentioned there is, in addition to not opening new accounts, you definitely don't want to close any accounts either, because that can impact your credit. So when you close out accounts, that does have an impact on your credit scores. So even if it's an account that's at a zero balance, you're not using, you don't intend to use, just let it sit there, remain status quo until after the keys are in your hand.
So if you've got pre-approved with a certain credit scenario, keep it that way, because that's
exactly
that's what's going to get you to the closing table.
It's remaining status quo. And one of the other things that has happened recently is had a consumer that took out a personal loan from a company that is really more intended for credit card consolidation. Okay, and they're all over the radio and the and TV for ads. So I won't mention any names. I don't want to libel suit against me. But so this individual took out a loan which is intended for credit card consolidation, and use that money instead of consolidating credit cards, wanted to use that as the down payment on the home. Can't do that. Down payment money can't be borrowed. It needs to be your own funds. So you can't borrow 10 or 20, 30, or $5. You can't borrow any money for the down payment. The one exception is if you're borrowing from yourself and you're taking a loan against your own 401k or retirement accounts. Perfectly acceptable.
Just kind of a side note, Patrick, gifting. You get a gift from an in-law or a parent.
Sure. Yeah. So gifts are fine in the vast majority of circumstances, but you need to have the paper trail to prove it really is a gift. Okay. So there's a document called a gift letter, which is something that the gift donor and the gift recipient sign, that basically tells everybody it really is a gift. It's not a loan. There's no repayments that are required. And we need to see a copy of the gift check. You need to see the money coming out of the donor's account and being deposited into the recipient's account. So if you're, so it's one of the other do's and don'ts here in terms of moving money around between different accounts. So you can do that. You can, pool your money from several different accounts and put it all into one account to use that for the transaction. Perfectly fine. But you need to keep a transactional record. So you need to show, okay, so that $10,000 was withdrawn from bank X and deposited into bank Y. And the dates and the dollar amounts have to match up. And same thing with the gift. You can receive the gift funds. We just need that paper trail to prove that that's where the money is coming from.
So, Patrick, that's where you're consolidating your liquid funds, liquid assets that you have. I think your don'ts is, but don't consolidate credit cards. Don't consolidate your. So that's money in the bank. So we'll jump back to credit here for a second. So again, that example, someone may think, okay, well, I've got a $5,000 balance on my credit card. I'll pay that off, so I'll look stronger. Not always the case. And if you have multiple different accounts with multiple different credit card companies, I've seen people think that it's going to make them look financially stronger if they consolidate all of those onto one card that has a 0% interest for 6 months or a year or whatever, and it's going to help them eventually pay that off quicker. Not a good idea to do while you're involved in the mortgage process. Okay, pretty much you want to keep your credit status quo. You don't want to open any new accounts, don't want to close any accounts, you don't want to consolidate accounts, because that is going to, for a short term, play havoc with your credit scores. So opening up a new account will cause your credit scores to dip a little bit until you've had that account established and you have a track record of making payments on that new account.
Okay. So again, the most important thing is just remain status quo when it comes to your credit. Don't make any changes. It can, even though you may think it's a good thing, it's going to come across as you being a stronger borrower, a stronger candidate for financing. That's not always how sort of the rules are interpreted and how the actual details come together.
Very good.
Yep. So what else do we have on the list? So collection accounts. So let's talk about that. So again, some credit advice. Paying off a collection account, again, may seem like a good thing to do to make you appear as a stronger borrower, that collection account no longer exists. But paying off a collection account actually can drop your credit scores, can actually hurt your scores. It all has to do with how recently that collection account has been reported. So without getting into all the details, the best advice is talk to your loan officer before you make any changes, before you try to consolidate, before you try and pay anything off, whether it be a good reporting trade line you've never had any lates on, or it be something that's in collection. You want to talk to your loan officer before you make those changes.
I imagine that has something to do with your timing as well, right? If you're starting and you figured 6 months down the road, you're going to buy a house, maybe there are things you can do to improve it down the road, but you're going to take a hit at the time.
Exactly. And that's why in my practice, the sooner I can talk to a prospective homeowner, the better. So ideally, I want to talk to someone 6 to 8 months before they think they're ready to buy a home. Now, that may seem like a really long time, but it's for items like this. So we can take a look at the credit. We can give you some advice and some tips on what to do to maximize the credit score so that when you're ready to buy, your credit is in the best shape with the highest scores to allow you to get the best possible financing terms when you are ready to buy. And in most cases, if we've got 6 or 8 months to work with, I won't say everything, but most credit issues can be resolved in that time frame, and you'll end up with a better score as a result. So again, the best advice is talk to your loan officer. If you don't have a loan officer, I'd be happy to apply for that job. Give me a call, get in touch, and we can walk you through some of the credit do's and don'ts. Let's see here.
So one of the one of my first pieces of advice when I give to somebody that comes to me to purchase real estate is to speak to somebody. Are you pre-approved? You've spoken to a loan officer. But what you're saying is, if you really want to do it right, go pre-approval. Get in touch with you, before all of this starts, because it's going to set you up so you can get pre-approved and
it's the get ready to get ready conversation.
Got it.
Yep. So most of that stuff has to do with purchasing. It actually applies to refinances as well. But one of the last points that I want to make is really more on the refinance side of things, and that comes to home improvements. Okay. So again, another disaster story that happened with a client, no names to protect the not so innocent, but had a client who was taking cash out, had a good equity position, but they were taking cash out because they wanted to redo their kitchen and their bath. Perfectly reasonable. Sounds like a everyday common occurrence, and it pretty much is. I hope clients do stuff like that all the time. So we took their application, put the application in a process, ordered the appraisal and the title work, and all the normal things that we do. And so this was a number of years ago. I got a phone call from the appraiser as they are backing out of the driveway. They were there to inspect the home, and the homeowner did not follow instructions. So after we put the application in a process, I gave him all the instructions: remain status quo, don't change anything with credit, don't make any changes physically to the property. We're going to send the appraiser out there. Well, he thought because he was doing this refinance to take cash out to remodel the kitchen and bath, and he told me that was the purpose, which he did, that it would be okay for him to start doing the demo on the kitchen and the bath. Well, when the appraiser goes out there, literally the kitchen and bath are completely demoed. The kitchen doesn't exist. There's no cabinetry. There's no appliances. It's gutted back to the studs. Same thing with the bathroom. So that was an issue.
Yeah,
Okay.
that's the current value of the properties based on
Well,
what
exactly.
the value of the property is.
It's the value and condition at the time the appraiser is there to inspect it. Now, if he had waited literally, 2 more days, 3 more days, and started the demo after the appraiser left, chances are there wouldn't be any issues because the appraiser would have seen a complete kitchen, complete bath, intact, functional, operational. So the advice there is, even if you're planning to make improvements to the property, and that's the purpose of the transaction, you don't want to start doing that work until after the appraisal inspection has taken place. Because again, the home is the collateral for the dollars being issued. And from a lender's perspective, it's an incomplete home. It's a construction project. It's not a finished home, and that's an entirely different set of financing circumstances. So, if you're refinancing a home, don't make any changes to the property, even if you think there are improvements. You're updating the kitchen, you're updating the bath. You don't want to make those improvements until after, ideally until after the closing, but definitely not until after the appraiser has left the property.
Right. So if you're kind of tying it in a loop, it's start early, speak to your loan officer early, listen to the loan officer, unlike your previous story.
And again, this is, send it out to all my clients a couple of times throughout the process, the list of the do's and don'ts. Anybody that's watching would like to have a copy of that, just send me a direct message, drop a comment here, and I'll get a copy of it out to you. Again, it's a list of the do's and don'ts. But yeah, you're right, Declan. It's start early.
And start early, listen, and status quo. Just keep going the way you were going.
Exactly.
If you're told you're on the right track, stay there. Don't make any changes until you get those keys.
Yeah, and sort of jokingly, I tell my clients the most important question to ask yourself through the whole process is, what would Patrick do? And if you don't know what Patrick would do, pick up the phone and give me a call, and I'll tell you.
T-shirts done up. What would Patrick do?
Well, exactly. Yeah. So that's we'll get that to the printing press. I can see that's going to be a bestseller for sure. So I think what we'll do, Declan, is we focused this episode mostly on the financing side of things, what can go wrong, sort of the do's and don'ts when it comes to the mortgage financing perspective. Let's throw it over to you for the next episode, and let's talk about some of the do's and don'ts when it comes, strictly to the real estate side of things. And
we can,
similar to the mortgage side, people don't know what they don't know. They think they're making the correct choice and doing the right thing, and it ends up hurting them. So there's stuff like that on your side too.
We'll make that a 5-hour episode. I'll try to keep it 30 minutes.
A 10-part series.
Absolutely. And I'll try and give some of the ins and outs, and some of it's going to be obvious, some of it's not going to be so obvious. So I'm certainly looking forward to that. I think that could be an interesting topic.
Okay. All right. So you heard it here, folks. A 2-part episode here. So this was part 1, the do's and don'ts on the financing side of things. Declan will be taking you over the show for the next episode to give us the do's and don'ts on the real estate side of things. We're hitting right about a half hour right now, so let's wrap it up. I think in the radio business they call that a big market tease. So that's a tease for the next episode, right? So why don't we wrap it up, Declan? Some good tips, some do's and don'ts for people involved in purchasing and refinancing homes. Thanks for jumping on with me this morning, Declan, my co-host here. And this is another episode of the Wicked Awesome Report, broadcasting every Tuesday and Thursday at 10 a.m. or 10-ish, depending on our technical difficulties. So thanks for tuning in. Thanks for joining us, Declan.
Thanks for having me, Patrick, and I look forward to seeing everybody on Thursday.
Yeah, so we'll be broadcasting again in a couple of days. Until then, hope everybody stays well and everybody stays awesome. That's a wrap for the Wicked Awesome Report. Let's stop the live stream.